So it's been a pretty wild couple of days since I did one of these live streams on my own. We're going to talk a little bit about that. We're going to talk a little bit about S&P price targets, how people get there, and where I think we should probably be thinking about this. And I also wanted to talk about position sizing. So I had a good friend of mine who trades options as a day trader, and we're going to talk about position sizing. I think that's an important topic today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. I am hoping that most of you are managing through the market tumult that we've been experiencing over the past several days fairly well. I will tell you right now that in my own experience, I had a little bit of a fiasco with my trading system today. I've become somewhat convinced that when there is a trading system problem, it will never end up in your favor. In all the decades that I've been doing this, I have yet to see a situation where a system fails and somehow it works out for the good. But be that as it may, one of the things that I was just talking about was position sizing. And the reason this came up was a longtime friend of mine who is a self-directed investor. He likes to use options to make his directional bets. And he makes some pretty good calls. I like talking to him for his insights. But when he discussed his trading P&L with me, it didn't reconcile with the direction that he had been taking in most cases. He had been bearish on the market. He had been bullish on gold. He had a lot of ideas right. But over the course of the last couple of months, his trading P&L was not so good. And I tried to delve into that a little bit with him to understand what was going on. How could he have been so right and yet not have done particularly well from a trading perspective when he really had the overarching and most important themes right? And what we finally discerned was that this actually was related to the amount of risk that was being taken. And I actually built a spreadsheet for him to illustrate a point, but I thought afterwards, you know what, this could actually have some utility for everybody who might be interested. So let me just get my desktop share going here so we can take a peek. And hopefully this will come up. Okay, so what you should be seeing right now, or will be seeing very soon, is just a very simple P&L chart. So this P&L chart goes back to February 19th. It's using a representative sample size of, we'll start with 100,000 in capital. And I'll just describe what the trading strategy is here. So imagine, and this is not what I do. I don't trade a lot of 0-day to expiration options, but I know that a lot of people do. Perhaps some of you viewers do. And so I came up with a strategy that just said, let's assume that on February 19th, which was essentially the market's peak, that you had a bearish perspective on the S&P, and you wanted to use 0-day to expiration options to affect that view. And you were going to do it very systematically. So what you were going to do is you're going to say, you know what, I'm going to buy a 25 basis point out of the money put option on the S&P on the close each day for the following trading day. And I'm just going to do that every single day. Now, of course, the market has fallen precipitously since then. So as one would expect, this is a trading strategy that would have paid off fairly nicely. So if you look at my spreadsheet here, I'm just going to highlight different cells. It's not hugely important that you can see each of these cells, but I'll blow them up from time to time. I'm going to highlight them and then show these as big numbers. So up here, this first number that I've highlighted, minus 25 basis points, that is the 0 DTE SPX put option that this back test is is using. So essentially what's going on here is it takes the S&P price, it figures out what 25 basis points to the downside is. It then rounds that to a legitimate SPX strike. Then the spreadsheet goes and it looks up that options price as of the close, and then it calculates the settlement of that on the subsequent close. So in this case, we're just looking at a 25 basis point out of the money put option purchased every day on the close, expiring on the following trading day's close. Okay? And we're starting with $100,000 in capital. This number over here, which I'm going to highlight now and blow up for a large size as well. So I'll just make this bold and I'll make it a nice big number so everybody can see it. Okay. This 5% is how much of the $100,000 in capital this backtest assumes that you laid out on this trade, right? So 5% of 100,000 is on the first day a $5,000 outlay. It then calculates your P&L and your capital will rise and fall. And it always takes a fixed 5% of whatever your capital base is to do this. And the reason I built this spreadsheet for this friend of mine was because I wanted to illustrate to him that you do not increase your profits for a trading strategy simply because you bet more money, even if you're right. And the reason is because the losses that you incur when you are wrong might carry you out. And let me show you how this works. So this assumes you put 5% of your capital, whatever that capital is at the end of the trading day, into purchasing the puts for the next day. Let's increase this to 10. And if you're looking over here, you can watch this, the y-axis, and you're going to see that just grew. So at 5%, my terminal value is now $1.159 million. So far, so good. If I double how much I risk again, that increased my performance once more to $3.5 million. So about double what you were previously making. But what happens if I double this again? The total amount of money that you would make has now gone down. So increasing the amount of capital that you risk each time, because the drawdowns were so big, ended up really impacting the returns. Let's double it again to 80%. In fact, you never would have made it to today. You actually would have used up almost all of your capital on this day, which was March 17th. So if you bet 80% of your capital on this strategy, which was a great strategy, and look, this is a backtest strategy. We knew that the market went down. So this is not this is not a recommendation that, oh, what you should do is buy a 25 basis point out of the money put every single day. That obviously is not a great strategy, and it particularly wouldn't work out in a bull market. But what I wanted to illustrate is that how much you wager when you trade options makes a huge, huge difference. So very nice results if you risked 10% of your capital, 20% on options that expire the following day is a pretty risky strategy. What you can see, and this is the part I really want you to pay attention to, is this drawdown section right here, right? So this is where you really start paying the price. Now, as it happened, because the market really cratered last Thursday and Friday, that's where a lot of the money would have been made back. But you can see that the damage is being done in this region. So at 5%, you get actually reasonably attractive rates of return, and you're risking a modest amount. At 10%, you can see that those drawdowns are more significant. Peak to trough, you would have gotten up to about 800,000, seen it drop down to less than 500 before getting up into this neighborhood. So I just wanted to make this point. I think this is really an important element. And as you can see here, you know, one of the ways you can sort of tell that the amount of capital is creating real problems is that you can see that the terminal value is lower than the peak value, and the peak value was a long time before when you start getting into this situation, right? So we get into 20%, the terminal value is higher. At 25%, the terminal value is that higher or not? I'm not quite sure. At 27%, it's already lower. So this is just an important thing to keep in mind as you work through a strategy. So the next question is, well, what is the appropriate amount to bet? Some people have worked on this. There's actually a formula called the Kelly criterion. I'm not going to bother to go through the whole exercise with everybody now. It was a guy who worked at Bell Labs, if memory serves. But really, how much you're going to wager is going to be a function of the probability of a win versus the probability of a loss, and how much you make if you win versus how much you lose if you lose. So the amounts of, and that actually helps you define what the optimal amount to bet. And the reason I made this point to him is because what I noticed was that there was a tendency to say, oh, I'm going to buy X number of contracts. And he did that regardless of what his capital base was. So, what ended up happening was that as the capital base came down, the wager size was way too big, and you could have losses that really end up impacting your long-term results because your capital base is completely diminished. So, I don't know if this, I would say this to him, but then I realized illustrating it is sometimes show somebody it's sometimes a little bit better than just explaining. You're betting too much, even though your ideas are good. You're betting too much. So I hope that helps everybody. Okay, so the next thing I wanted to get to, I'm going to blow this up a little bit as well. The next thing I wanted to get to was something that I was writing about over the weekend. Now, I've talked about this on the channel before. I'd just like to talk a little bit about year-end price targets for the S&P and these drawdowns that we've seen most recently. Because a lot of people are attributing this whole market pullback that we've had, and it's been significant, to tariffs, right? So I don't know where we closed today, down 23 basis. We're basically flat on the day. But I will just very quickly, no, I won't very quickly because it's not pulling up a new tab. Okay, do it over here. So peak to trough, I think net of, at one point we were actually in a formal bear market, which is defined as a 20% drawdown peak to trough. So I'm not exactly sure where we closed on that day. Let's call it 61.47, okay. And this is where we are now. So we're down about 18%. In round numbers, peak to trough. So not in a formal bear market, although we did touch that territory. My own view is that we were going to get a formal bear market decline. But there is something I would like to discuss, which is that, we had a lot of sell-side price targets that were in the mid-6s and even up to 7,000 in the S&P. And that didn't seem that far-fetched when the S&P was 6150, right? So you could say, well, up just 10% from 6150 is going to get us up in that, 6,800 neighborhood. If we had a 12.5, 15% increase, now we're getting up to 7,000 in the S&P. Here's the issue that I personally had with that. And the issue that I had was that we know a couple of things about the current administration's objectives. One of these objectives is to reduce government spending, and as I've previously described, GDP, C plus I plus G plus an X. It's very difficult to get GDP growth if you are materially cutting government spending, which needs to happen, but some pain will undoubtedly accompany that. I've previously described that as we think about it, we should expect that the revenues for the S&P are going to increase at, call it the nominal or better GDP growth. And earnings typically grow faster than that. But the concern I had specifically last year, as we look at some of these things, is, so here's this I think is kind of an interesting chart. I drew these lines before we went live today. So let me just talk a little bit about what these things are. So the blue line represents S&P revenue. So S&P revenue, compound annual growth rate of about 4.23%. And the brown line over here, this represents operating margins for the S&P in the aggregate over the last 25 years. And I drew these two lines, so I basically said, okay, let's just assume that the white line is the upper end of operating margins, and the red line is kind of the lower end of operating margins. You'll notice that operating margins have indeed been lower, but this was a recession over here. This is yearly. If I bump this up to quarterly, so let me put quarterly in here. Okay, so that still has those two lines. You're going to see that there's some other instances where operating margins fall below this lower boundary of about 11%, and a couple periods where it actually just coming out of the pandemic where it was in excess of the upper boundary. But one of the things you will observe is that if you take a long-term historical view of operating margins for the S&P, what you're going to find is that the operating assumption for most of the strategists that are publishing these S&P numbers has those operating margins at the upper end of the boundary. So there was kind of a lot of good news being baked into the cake, right? So if we take a lower operating margin assumption, right? So this is the highest that it ever achieved, and this is the lowest. Let's just say we took the median. The median operating margins for the S&P over the last 30 years or so is about 12.6%. And if we assume also that the top line is growing at nominal GDP, and I'm saying nominal GDP historically, so we're looking at close to 4%. What that gets us to is an earnings estimate of about 286.56. Now, don't worry about these pennies because, these are just forward-looking estimates. And then you throw a median multiple on that of about 18 times. Well, that gets you to about 51.60. We're not far off of that now. We closed at 50.62.25. So if you assume that sales growth is, sort of on trend, if you assume that operating margins are over, somewhere near the median of what they historically have been. Now, so why were people making these assumptions about these bigger numbers? Well, I think part of that was that they assumed that the incoming administration, the new administration, the current administration, was more business friendly, higher operating margins, higher growth, all of those good things. But I think the bloom is kind of off the rose as we think about the fact that there has to be some government spending cuts. We do need some measure of trade fairness. Now, I'm not, as I said on Friday, for those who watched, I was not enamored of either the numbers that came out, the way they were presented. There's a lot about this that didn't strike me as being maybe the way I would have handled it. Of course, I am not the President of the United States, and I am not in any position, arguably. But, maybe I would have handled things a little bit differently. I'm not crazy about the way things were handled, and I'm not crazy about the numbers that were chosen. Be that as it may, we play the cards we're dealt, not the ones we wish we were dealt. And so, this gives us a sense of, where maybe these things, where, a decent number should be. Now, I will also point out that in a bear market, it's not uncommon for the market to overshoot. How could it overshoot? Well, it could overshoot by having a lower multiple. So if it normally trades 18 times forward, maybe it trades 17. Or maybe it trades 16 times, right? We've certainly gotten, that gets us over here. Could operating margins be below the median? They could. You could have operating margins that are closer to 12%. Oh, that didn't update for whatever reason. Why did I not do that? This should be this times D5, right? Oops. There we go. There we are. So this is the median. That gets us down to 4,000. 16 times 4,000 or 18 times the median earnings estimate. That gets us over here. So I was saying that I think my S&P price fair value. Okay, so what fair value is different than a price target because I don't know what the market's going to do. Maybe it's going to go higher, maybe it's going to go lower. But I think that a very reasonable valuation for the S&P, given what we currently know, is going to be, making an assumption that it's going to be at 12.6-ish. That's the median. So I'm just going to say we have median operating earnings. I'm going to say we have, something close to the median in terms of top-line growth, and we're going to have something close to a median multiple. That's going to get us in this, 42.50 to 52.50 price range for the S&P, and we're within that range right now, which is kind of fair value. If we get a lot of bad news coming out of the tariff situation, such that we have to take down our GDP growth estimate, well, then you have to take the top line down by about 1%. What would that do? Well, 1% is about $190 off of this, so that takes us to 1,800, and then you take that same multiple, and that takes us down to 4,000, right? So as you're trying to think about the moving pieces, how does GDP growth impact this? Just take a 1%, like a multiplier of 1 against your sales or revenue assumptions for the index. That's just a starting point, right? So, of course, there are ways to get a little bit more finesse into this. The bigger tech companies all have a much bigger bearing on this because they have such huge weightings. NVIDIA, obviously. And that's one of the reasons, I think this is an important point, is that one of the reasons that the operating margin assumptions for the S&P have risen so sharply in recent years, and that we are having people saying, okay, we're going to be 14, 15, 16% operating margins, is because you've got heavily weighted companies like NVIDIA sitting in here. And this is a company that's got a 54.6 after-tax net income margin. So anyway, those are the concepts I wanted to get to before I took your questions. And so with that, I'm going to move on to your questions and see what we have. All right, so Steve Garcia, do you know how S&P EPS estimate ranges have changed for 2025? Are we now looking at 250 to 260, maybe lower? So interesting. Oh, actually, were you asking that question before I even got to this topic? That's so you put that up before the stream. Well, how about that? So I guess great minds think alike. So I hope that helped a little bit. 250, 260 is going to be, well, let's take a look, right? So let's just see where the street's at. But one of the things you want to think about is, do you think that earnings are going to fall? And that's a different question. So we're going to look at this. This is going to be quarterly, by the way. So the most recent quarter, we're looking at most recently fully reported quarter is 65.764. Oops. Where's my calculator? Not sure where my calculator is. It's okay. Use my computer instead. I think I was on a phone call and I was carrying it around as I walked around while I was on that call. So 65.74 is 262.96, assuming that earnings do not grow. So that's just flat off of the last reported quarter. Do I expect that? Well, not really. And to give you a sense of why not, let's just take a look at a long-term history. I mean, is it possible we have these little periods in here? I guess it certainly could happen. But this is a long-term history of S&P earnings growth. The times when it has turned negative, it has grown, didn't really grow in here. Didn't really grow in here. This was during the tech wreck. Didn't obviously during the GFC. But don't forget that this incorporated a lot of losses from financials. This encouraged a lot of losses from the pandemic. A decline, it doesn't really happen without something sort of more meaningfully catastrophic going on. Is it possible? It is possible, but I think 262 isn't a bad base case for S&P earnings. And if you base case. I don't mean base case. I mean sort of low end estimate. Let's try that. That would, I think, be a reasonable number. And if you take 262, 263, throw an 18 multiple on that, that's 47.34. 47.34 versus where we are right now. and I'm looking at corn futures instead. I think it was 50.60. That's down 6% from here, right? So that's assuming no earnings growth. That's another 6.5% to the downside. That's kind of the downside risk case. Now, that doesn't mean worse things can't happen. They can. But I hope that that helps. Good morning, Mike Finwest. Happy to be with you again. Survived the earthquake. My history of living in California helped a bit. Yeah. I don't need to have any earthquakes right now. I just want my trading systems to work. So just so everybody is kind of aware, I won't bother to tell which platform I was using, but I wanted to take some profits on some SPX. As you guys know, I prefer SPX options for sort of my broad market types of stuff. Had an SPX position. Market was off considerably this morning. Wanted to monetize a position that I had. Went to liquidate the position, and it said, contract not found. It didn't know the instrument I was trying to sell, even though it had it in my position file. So, I could see it, I just could not. And apparently there were other system problems going on, and I was on hold for over an hour, I think, talking to this person and that to figure out what was going on. What a nightmare. So Finwest, yes, I trade 0 DTE in the triple Qs and SPYs every day. I'm curious, is there a reason why you use triple Q? Okay, I can understand using triple Q over NDX options because NDX options have a really big multiplier, so it's a big contract, and if you're trying to allocate a specific amount of capital, it's difficult because it's a bigger contract than SPX. But I'm curious why one would use SPY instead of SPX, because if people are wondering, well, why do you use SPX? Aren't the spreads a little bit wider? Isn't there a contract royalty that you have to pay? Yeah. The reason I like them is, and actually today's issue, which was with an SPX contract, as it happens, one of the reasons I like them is because I have no risk of exercise or assignment. They are a cash-settled instrument. So at the end of the day, it just settles out to cash. I have seen some legitimate disasters where people, exercised or got assigned on instruments either unknowingly or unwillingly, and then were exposed to the deltas of the resulting position that came out of that exercise or assignment. So that's the first thing. The other thing is, there were a lot of and I really feel for these people. I've actually had some people ask me about this after the fact. And this doesn't fix everything because you can't trade cash settled options in every underlying instrument. But there were a lot of people who had made bearish bets on regional banks like Silicon Valley Bank and Signature and some of these others. They'd made correct bets that the duration risk that these institutions had taken on were going to take them out to the woodshed, and those banks ultimately did fail. But I have heard of people who had made bearish bets, then they halted trading in the stock, and they weren't allowed to exercise their options because they couldn't get a locate on the stock. So they bought premium, made a bearish bet, they were right, and lost money. It was that didn't happen to me, but it was one of the worst things I'd ever heard. Cash settlement is a really attractive aspect of these things. No5 says SPX also has better tax treatment. Yeah, so you get the long short, the long and short-term capital gains tax treatment. I do believe. Now I don't happen to trade SPY options. I use the SPX, so. But I think somebody was telling me that there is a long-short capital gains tax treatment. Don't quote me on this, on the SPY options as well. I didn't know whether somebody lobbied for that because, iShares or whoever runs SPY didn't want to have a tax disadvantage relative to SPX. But that's just a reason I like to use it. So hopefully that helps. No5 says the Kelly formula was an attempt to beat the house while gambling on blackjack. Yeah. So the Kelly formula, and they have iterations of the Kelly formula that are specifically designed it's basically derivations of that approach for understanding how much you should be wagering. But the broader point is this, so I'm not trying to give somebody a set and forget formula. Besides which, even to use a closed form solution to identifying how much capital you have to allocate to a given trade, you need to first have an accurate representation of the probability of a win or a loss and how much you would win or lose in each circumstance. And those themselves are going to be loose estimates. In a casino game, these things are known. You know what your odds are, and you know what your payoff is going to be for those games. And you don't know that here. So there's actually more unknowns, but I was really using it for an illustrative purpose. And actually, the example I was giving was not blackjack. It was buying 25 basis point out of the money 0 GTE SPX options based on actual prices dated back to February 19th and running it through the current day. So it sort of illustrates just how important that is one way or the other. Steve Garcia says, also as a follow-up, I was just thinking that it might make sense to be long 5 to 20-year U.S. bonds, but they really didn't cooperate today, just an aberration. 20-year bonds, no. I have no interest. Well, first of all, to what end? I mean, the only reason you would buy long-dated treasuries is because you believe that long rates are going to fall and fall hard, because that's a capital appreciation trade. And the reason I say that is because you can get comparable rates of interest in short and midterm treasuries, right? So right here, you can see that a 30-year pays less than a 20-year. And, if you just go out a 5-year period, you're still getting over 4%. You're not going to take on huge amounts of duration. I'm not, even bills are paying over 4%. I don't like taking on a whole lot of duration at this point, I have to say. It's not that I don't think that long-term rates can't come down. I think they can. I just don't like the risk-reward. I think it's asymmetric, and it could be quite brutal. And to illustrate this, let me just remind everybody of what happens to those long-dated bonds when rates start going against you. So we're going to take a look at this. We're going to look at a 5-year history for TLT, which is the ETF that tracks the long-term bond. And you can see that once they started raising rates, you're taking massive amounts of interest rate risk when you own this stuff. And, peak to trough, 20-year Treasury bonds fell 52%. And that's just brutal. Now, they wouldn't fall as much now. I mean, the thing is that it's a function, the convexity is going to be a function of the rates also. So, how much sensitivity you have. It's not like you're at 0% interest rates now. But I'm just saying, that there's real risk there. I would probably, go out 5 years at the most, 5-6 years, something like that. Maybe you can start taking a look at corporates if we see some expansion in credit spreads. They haven't come up as much as I thought they needed to. So, what do we got here? You talked about time arbitrage, trade as if you're long game a day-to-day. Oh, yeah. So when I was talking about that time arbitrage, that was Bruno. That was not my idea. So I don't want to. It's actually a talk that Bruno Dupier, is a Frenchman. He's the head quant at Bloomberg, and I believe he's still there. I have not seen or spoken to him. Last time I saw this guy, we had lunch together in Naples, Florida, and my gosh, I mean that's got to be like 12 years ago. So this is Bruno, and it looks like they're going to have an event coming up. Yep. So he's going to be holding a seminar. It was his idea. What he observed was that these are past. Oh yeah, so this is March. Okay, well he's probably got to have some coming up. But in any case, yeah, I guess he's still at Bloomberg. What he had observed was that volatility does not behave exactly the way you would expect it to. So we use this commonly. I've actually discussed it on this live stream. That we speak about vol always in annualized terms. So if you hear somebody say 30 vol, they're always talking about it in an annualized sense, whether they're talking about it's going to be 30 vol until the end of this week, the end of this month, the end of this quarter, or whatever. The way you normalize this through time is if you take the annualized number and you want to figure out what it's going to be for one day, you divide by this square root of time. So there's 256 trading days in a year. If you want to know what the volatility is for one day, then you take the square root of 256, that's 16, and you take the volatility divided by 16. So if it was 32 vol, then you divide by 16, that's going to be 2. So your standard deviation for one day is 2. If you want to figure out for a week, there's 52 weeks in a year, square root of 52, 7.46 or whatever it is, divide the number by that, and you'll get your weekly standard deviation. There's 4 quarters a year. Square root of 4 is 2. So if you want to know what the standard deviation is for a 32 vol annual over the course of a quarter, it's going to be 16, like that. So you can do these things in your head. And Bruno's observation was that in reality, intraday volatility doesn't work out that way. So when you start distilling volatility down, and he was looking at open, high, low, close, that intraday volatility, and what his observation was is that intraday volatility, minute to minute, hour to hour, first half of the session to the second half of the session, does not really behave the way that math suggests. So there's 6.5 hours in a trading day. So, 6.5 times 256, take the square root of that, and then you divide 32 vol or 20 or whatever your annualized volatility number is by that number, then that should be the standard deviation for a trading hour. You can divide it into 15-minute segments, divide it into whatever you want. But his observation was that the intraday volatility that's actually exhibited in the market tends to be greater than the volatility week by week. So what he said is, trade long vol during the day and then short vol from one week to the next. Now, it's interesting because when he gave this lecture that I saw, they didn't have 0 day to expiration options back then. So what he actually did was he said, well, assume you're long gamma and trade accordingly during the day and then true up weekly. So he basically said, assume you're long gamma for the long book and assume you're short gamma for the short book. The long and short book cancel out. So what he was saying is that you would actually trade as if you were long gamma, so buy on dips, sell on rips day to day, and then true up your deltas every week. And in theory, that should work out. That was the observation that he was making. I will tell you, let's just imagine how that might have worked out, though, over the course of the last week. How would that have done? Probably not that great. Why? Because you would have been a buyer of equities as they declined on Thursday. And you would have been a buyer of equities again as they fell on Friday. And then today, I think we're basically flat. So just bear that in mind and then push that out to the end of this coming Wednesday, because that would be a full week, and see whether that would have, whether that would have been something that your capital base could have supported. But the more important point to me is that it helps explain, among other things. So a lot of people like to talk. Why isn't my screen coming up here? Come up. Oh, there it is. Okay. So it helps explain this. As we look at the term structure, now right now the term structure is inverted anyway because we've been having all of these shocks. So we have very elevated short-term vol, right? But the truth is that even if you normally have a circumstance, and maybe I can I do this? I'm not sure if I can. I was going to try to draw on the screen, but I'm not sure if I know how to do that with this function that I have. The observation I would make is that what this suggests is that the normal term structure, which would, we're going to go back in time. I'll show you what it might have looked like Yeah, we'll call it 2 months ago. Why not? Let's go back to, you know what? We've been talking about the 19th of February. Let's just go back to then. So put in the 19th of February. Okay. So this is what the term structure looked like then. Normal, upward sloping, contango. And this is what it looks like now. The interesting thing is, if you can make this out, I'm going to get rid of today's. Do you see here how the 0 day to expiration and the 1 day are slightly higher than the ones that immediately follow? Well, his research suggests that there is some quantifiable reason why that's true. That the 0 day to expiration options, and boy, were they really that cheap? 9 vol? Wow. It illustrates that I don't trade 0 DTE, generally speaking, that I didn't even know that. That they were down sub 10. It looks like 2 day to expiration. So on the 19th, the Feb 24th options were 8 vol. Wow. Now I'm getting more increasingly intrigued. Maybe I should pay more attention to this. Should trade these 0 day to expiration options. But so let's see here. Tucker D Dog says tariffs can crush operating margins. Yes, actually, I wasn't probably where I should have been here. I'm gonna follow these up. Last Wednesday, you talked about the trade arbitrage. Okay, that's what we just talked about, which is that the volatility intraday can be different than from week to week, month to month, and so on. That formula I described, it isn't just the square root of time. Tariffs can crush operating margins. Yes, that's true. This is what you get when you have an admin that asks Chat GPT to flesh out their strategies and produce deliverables. This is what you get when you have an admin. I don't know what you're referring to. Be honest, how did a person with your wealth of knowledge do during 2025? I'm up 1%. Yeah, I'm up 1% year to date. So not great. I mean, look, I don't have the same advantages that I had when I was in an institutional position. I will certainly say that. But, you know, when I was running a long-only equity fund in 2022 and 2023, let's see, what was let's see if I can find it. I think we outperformed the S&P was down in 2022, and I think we were flat to up small. So it was like 160 basis points net of fees. We had a 1% management fee on that. And then in 2023, I think we were up 20%, which lagged. And you know, the exact numbers escape me now. And you know, returns are also a little bit tricky. You know, I'll give you an example. So in 1998, we made 70% return on capital when I was at Gateway. 1999, we made 140% return on capital. In 2000, we made a 560% return on capital. In 2001, we lost 40%. But those types of returns don't necessarily translate because, you know, we had access to Goldman's balance sheet at the time. We had what's called a JBO. So I don't know that the risk. And the other thing is that, you know, when we're trading vol, which is what we were doing there, and when I was at Cantor, same thing, I was trading a vol book. It doesn't translate that handily to self-directed investors. That doesn't mean that the things I'm talking about don't have real applicability, because every one of you is going to be trading a different strategy. Are you just typically long equities and you're doing some kind of overwriting to generate some additional premium? Are you looking for hedges? Are you looking for levered ways to make directional bets? Those things are very different than trading volatility. So volatility is when, you know, you're basically trying to be delta neutral. So not make too much of a directional bet. In 22 and 23, the 40 Act fund was equity long only. informed by what we saw in options. So I had to be long delta, which isn't normally my preference, except just to be long, the S&P generally, because I think the dollar goes down over time and the S&P grows over time, and that's a reality. If you're looking 10 years out, you should be long stocks. If you're looking 20 years out, you should definitely be long stocks. You should be long a little bit of gold. So, yeah, that's it. I mean, I don't know if that's what you wanted to hear or didn't want to hear. No idea. If you want to know, by the way, I mean, I don't know if these numbers will be published, but Parallax Volatility, what is their name now? Parallax Volatility Advisors, but that's a hedge fund that's based a few miles from where I'm sitting right now. And years ago we competed with these guys when we were all effectively market makers, and they turned it into a hedge fund, a very successful one, and they had a phenomenal track record for years. If memory serves, between 1998 and 2012, they averaged 22.5% a year in returns net of fees, which were huge fees, by the way, with one down year, 2009. And that was a huge rebound year for the S&P. So if you're always long equities, it's a great non-correlated investment to have, for any of you who are out there and you're institutional investors and you're wondering about this kind of stuff. Okay. So Michael Anthony says Pfizer raised $3.24 billion more in cash by selling shares in another company's stock, and 6 insiders bought at 25. That's a good sign. At 25.35. So I've not been enamored of Pfizer, admittedly. I want to throw out the vaccine era, and actually I think the market largely has at this point. But one of the things that I just thought was chronically disappointing, and I'm going to go back in time to before the pandemic period, and just show that year in, year out, this thing really suffered. They had a couple years, like 2010, a good year. They had a big revenue increase there. There might have been a corporate action associated with that. But in general, they have a mature, their drugs are fairly mature. They didn't have a really good pipeline. They just weren't getting a lot of top line growth. Good free cash flow. But it just didn't excite me that much. And it's a relative thing, right? So if you imagine that you're going to buy a stock and you have to hold on to it and shut your eyes and never get a chance to sell it until, say, the day you retire. Well, I don't like companies that aren't growing the top line. But in contravention to that, number one, if the executives are buying the stock, that's a good sign. Always like to see that. And the other thing is, sometimes companies are starting to get very, very cheap. And Pfizer is one of these companies that is indeed getting very, very cheap. Looks to, as you can see here, the street's basically looking for almost $3 a share. All right, so the thing's trading about a little over 7 times earnings. Even if you discount that and you say, you know what, I don't think it's going to do it. I think they're going to make what they made last year. Well, that's $2.30 a share. Still a pretty good number. It's only 10 times, right? Think about it in free cash flow terms. Its free cash flow yield is over 10%. And as you point out, it's making a dividend. So, and these tend to be more immune to, the business cycle. So it's not terrible. I would also say, though, that if you get a 50% pop out of it, and you'd say, oh, well, now it's trading 15 times earnings and 15 times as cheap. Well, not for a company that's not growing. So if you get a 50% pop out of it, I think it's a fine place to keep your money. But this is not like a buy and hold forever kind of a name, in my opinion, for that reason. And I've said this many times. If I'm looking for a company that I think is a great buy, in general, I want to see that thing growing its top line. There's so many stocks out there. Why would you buy stocks that are not growing at least as fast as the S&P is? Because there's going to be risks associated with each and every business. The most outlandish would be they're lying, right? The numbers aren't real. It's like a 4Z best situation. Or in, Enron, right? There's always that risk. It's a very small risk, but it's there. So I want to see growth that's better than the market overall to help offset some of those risks. that they are going to be impacted by a business cycle or a change in consumer preferences or the fact that the numbers might not be real. And also because a growing company is something you can sit on for a long time and shut your eyes and you don't have to worry about. So it really has to be a standout. Now, granted, this is cheap. And there are also cycle situations. I'll also admit this. Like Micron Technologies is going to be it's going to whatever DRAM pricing is and things like this is going to drive their revenues up and down. So you're going to get some choppiness. But those things should all trade at a big discount to the market. They do. This thing's trading, whatever, less than half what the market multiple is. So yeah, that's okay. Okay. SPX better tax treatment. Yeah, that was what I was talking about. So for those of you who don't know, many years ago, oops, sorry, I always forget to turn that off. There was a situation where options traders were basically deferring their income indefinitely. How did they do that? Well, what you could do is you could trade something called conversions at the end of the year. What's a conversion? Conversion is when you get long the underlying stock and then you sell the stock synthetically. And why would you do this? Well, the stock gets a dividend. The reversal, the synthetic stock does not. You have no delta exposure. And an interesting thing would happen, and that is that, of course, the stock declines by the amount of the dividend when it goes ex-dividend. So if I have a $100 stock, pays a $1 dividend, all else equal, the stock will be 100 before the ex-dividend date, and it'll be 99 on the ex-dividend date. And you will receive the dividend. But the payable date of that dividend will be at some point in the future. So there was a period of time when some options traders, and this predated my arrival in the options markets, they would basically trade these conversions and essentially their marks would reflect the decline in the underlying stock price, but they would not get the dividend until the next year. And you could roll this, essentially you could push your gains out in time by doing this. Needless to say, the IRS, the Treasury, were not enamored of this situation, and they essentially reached an accord with the options markets, came up with some things called mixed straddles rules and some other stuff. And where SPX options, index options are concerned, they basically said, okay, well, we're going to treat some of it as long-term, some of it as short-term. There's this 60-40 long-short term capital gains rule that applies. Unfortunately, the states don't necessarily recognize this quite the same way. So the state of California, for example, doesn't even have a capital gains concept. It's all treated as income. Consult your own tax advisors about this. When you filled out your taxes, I'm sure you guys have seen this. If you look, when you're filling out the documentation, look for something that says mixed straddles. It's about this kind of an issue. But there is a favorable tax treatment that goes along with the indices and the options on them that applies in many circumstances. Again, not giving you tax advice, but it is something to be aware of and look into it. Okay, so, all right, so we talked about Pfizer. No5 says, agreed, the Kelly needs to be used in context. Yes. Again, I was not advocating the Kelly criterion as the way to allocate capital. What I was doing, though, is indicating that how much you risk should be a function of the probability of gains or losses, the amount that you make or lose, and all that kind of stuff. And I wanted to demonstrate because there are people, some watching. I mean, I know from some of your comments that you guys are trading 0 DTE options. How much do you bet when you do this? How much of a difference it can make? As I showed in that spreadsheet, it's a very formulaic strategy, makes a really big difference, right? You could trade 5% and you made, this is a very nice return profile over the course of 2 months. I think we can all agree. Start with 100,000, end with $373,000, right? With a drawdown that went peak to trough from 309 down to 233. That's a pretty big drawdown, 35%. It doesn't look that big because of this, but I just wanted to illustrate that where options are concerned, where especially if you're spending premium, because you can lose every bit of it if it doesn't pay off in 0 DTE options, you can see how what the impact is, that, you go to 50%, you lost all your money, or most of the money that you made. Look at this. You put 50%, at one point you'd have had 10 million, and then you gave it all back. So, I'm just making the point that when you trade options, manage the risk carefully, because I have absolutely seen and heard of stories. I'll tell a story which I think is quite remarkable. I heard this from some senior executives at a self-directed brokerage platform that will go unnamed. It was a cocktail function, and they hired a bunch of market strategists and traders and so on to speak to some of their better clients. And when I say their better clients, these were all clients that had a lot of money in their self-directed accounts. What's a lot of money? 9 figures, 100 million plus. And while I was talking to some of the executives, they recounted the story of a physician client of theirs who decided he was going to start trading futures. And I think it was a he. It may not have been, but I'm pretty sure it was. And he had started with $300,000. And within 4 months, he had traded the $300,000 up to, the number was something in the $33, $34 million range. Okay? So he had multiplied his account 100x in 4 months, which means he had to be taking massive amounts of risk. And I said, what do you guys do in a situation like that? I said, first of all, I was never really aware of how much self-directed brokerage platforms were really paying attention to the P&Ls of their individual accounts. But I assume for risk reasons they have to do that, maybe for compliance reasons too. I'm not in that business, so I don't know. And I said, when that happened, did you guys reach out to him and say, hey, maybe you want to think about your risk? And they said, yeah, they actually did. They had made numerous calls and made some suggestions that maybe he set some money aside, that he takes some courses on risk management. Anyway, long story short, he traded that over $30 million P&L down to 100. So he went from 300,000 to 34 million bucks to 100,000 in a 12-month period. Apparently, he was not interested in their insights about risk management. So, I just wanted to illustrate it, though, because, this is, kind of interesting. Okay, so Situation Room, Netflix was up today. Tariffs not an issue for them. Not an issue for them. That's referring to the tariffs nonsense formula. Yeah, I don't, like I said, I would have handled the, I see, that was the AI Chat GPT thing. Like I said, I would have handled the tariff situation a little differently. I'm sure many of us would have. I'm not Peter Navarro. I am not Howard Lutnick, although I worked for the guy for a number of years. I don't know Scott Bessent. I don't know Donald Trump. I know we have trade imbalance, unfairness that needs to be corrected, but I really struggle to understand, just as, from a gambler's perspective, if you trade, here's my question. Why do you go all in straight off the bat? I don't know what would have been lost by saying we're going to impose a 10% across the board tariff with all countries, and then we're going to start examining country by country, starting with the largest trade deficits first, the ones that we think are the biggest offenders, and we may raise them on those countries. We hope they will come to the negotiating table first. Would that have been such a disaster? I mean, I struggle to figure out what's wrong with that. That is the approach. And how long did it take me to come up with this scheme? I mean, that was essentially what occurred to me. That's actually what I expected, to be honest. Anybody who's watching this live stream a week ago when these things were announced and I was talking with Brian Stutland, I think you could see from our response how stunned both of us were. We were both blown away, frankly. And I think my first comment was, how is the VIX not up more? I would think it was up like 1.5 points in the after-hour session. How is that possible? If I was as stunned by that, everybody in the business must have been. I assume. So anyway, this isn't quite what I normally do because, I think I'd actually started a couple weeks ago by ending each one by saying, here's a couple maybe long or short stock ideas, and I'm going to get back to doing that. But I wanted to talk about this risk thing. I wanted to talk about S&P year-end price targets, get some sense of where this stuff is coming from. So here are some things I want to leave you guys with. If you're thinking about S&P revenues year on year, as a starting point, if you're not going to do all of the work and start taking the most heavily and biggest weighted companies in the S&P, just take the prior year revenue assumption and use your GDP estimate as a guideline for what the year-on-year growth might be. Take a look at the ranges of operating margins that we've had over the course of the last 30 years. I illustrated what those were. 12.6, in case you're wondering, that's the median. What did I do with my charts that I had that I was showing you guys? You get the point. 11% was the low end. 15% was the high end. 12.6 is the median. Start there, right? That just sort of gets you in the right direction. If corporate income taxes come down, the operating margin, the net income margin goes up, and the opposite. So these are the little knobs that we can use, and then just have a lot of fuzziness in the calculations. I think we're at probably a reasonable valuation for the S&P here. Like I said, 4250 to 5250, because all of these little nuances, I can't speak to them, but I think that kind of gets us to the right sort of place. And watch how much you risk. And on Wednesday, we will try to get back to what I was hoping to do more of, which is just identify some stocks that have gotten cheap, because some have. Pfizer, I guess 7 times forward earnings estimates, 10 times trailing. Maybe that one's cheap enough. Vistra Energy, which I mentioned on Fast Money on Fridays, trading 16 times. That's a utility. And if it's a more speculative utility, but utilities in general, this is an area where you're getting a 3% dividend yield. It's not too bad. So anyway, Michael Anthony is saying, which oil company you like best and why, about British Petroleum or APA. APA was one of the names that Mark Guthner mentioned on Friday. So we can get in. I'm about to sign off, so we'll get into that in somewhat greater detail, but it's a name that Mark Guthner is long. So I hope that helps. And I hope you guys found this helpful. And if you did, like, subscribe, notification bell, put your questions that you're hoping I can address that might take more time than just a cursory look into the comments section of the video, because that way, if I'm looking at the comment section tomorrow, I'll have a little bit more time and can formulate a little bit more. And with that, I hope to see you guys on Wednesday. Thanks for watching.